Hello and welcome to CryptoCurators.today. I'm Steve Gray, and before we dive into today's agenda, please remember that everything shared on this channel is for educational purposes only. We do not provide financial advice. If you enjoy our video and want to learn more, don't forget to smash that like button, subscribe, and drop your thoughts in the comments below, be they good, bad, or indifferent. We love hearing from you. Also, make sure to join our vibrant community forum at CryptoCurators.today. Let's get started with today's insights. As the world of non-fungible tokens, or NFTs, continues to grow, so does the complexity of managing tax obligations for investors. Many NFT collectors and traders are still trying to navigate the evolving regulatory landscape, which is rapidly catching up with the explosive growth of the digital asset market. Whether you're buying, selling, or holding NFTs, it is crucial to understand how taxes work and what you need to do to stay compliant. In this report, we will explore the key aspects of crypto taxes for NFT investors, including taxable events, reporting requirements, and strategies for minimizing tax liabilities. From understanding capital gains to navigating the nuances of tax treatment for digital assets, this guide will provide NFT investors with the essential information they need to know about taxes in the digital age. Purchasing NFTs. Buying an NFT with cryptocurrency is considered a taxable event in many jurisdictions. This is because using cryptocurrency to make a purchase is treated as a disposal of that cryptocurrency, which could result in a capital gain or loss. It's important for NFT investors to keep records of the purchase price and the value of the cryptocurrency at the time of the transaction to accurately calculate any taxable gain or loss. Selling NFTs. Selling an NFT is also a taxable event. When an investor sells an NFT, they may realize a capital gain or loss based on the difference between the NFT's selling price and its original cost basis. If the NFT is sold for a profit, the gain is subject to capital gains tax. The rate of taxation can depend on factors such as the length of time the NFT was held and the investor's overall tax situation. Trading NFTs. Trading one NFT for another is also considered a taxable event. In this case, both NFTs are valued at fair market value at the time of the trade, and any difference between the value of the acquired NFT and the disposed NFT may result in a taxable gain or loss. It's crucial to maintain accurate records of these transactions to ensure compliance. Royalties from NFT sales. Artists and creators who receive royalties from the resale of their NFTs are also subject to taxes. These royalties are typically considered ordinary income and must be reported as such. Artists should keep detailed records of all royalty payments received, as they are required to pay income tax on this revenue, earning NFTs through play-to-earn games. Some NFTs are earned as rewards in play-to-earn games. These NFTs are generally considered income at the time they are received, and the fair market value must be reported as taxable income. This applies regardless of whether the NFTs are sold or held, making it essential for gamers to keep accurate records. NFT investors need to understand the difference between capital gains and ordinary income, as this determines the tax rate applied to their earnings, capital gains. When an NFT is sold for a profit, the gain is considered a capital gain. Capital gains are classified as either short-term or long-term, depending on how long the NFT was held before being sold. Short-term gains, which apply to assets held for less than a year, are typically taxed at higher rates than long-term gains. Long-term gains, on the other hand, may benefit from reduced tax rates. Ordinary income earned from NFT-related activities such as royalties, staking rewards, or airdrops is generally considered ordinary income. This type of income is subject to the investor's regular income tax rate, which can vary depending on their overall income level. Record keeping. Keeping accurate records is crucial for NFT investors. This includes recording the date, value, and nature of each transaction, whether it's buying, selling, trading, or receiving NFTs. Records should include the value of the cryptocurrency used for purchases, any fees paid, and the fair market value of NFTs acquired or sold. Form 8949 and Schedule D. In the United States, NFT investors are typically required to report their capital gains and losses on Form 8949 and Schedule D of their tax return. Each NFT transaction must be listed along with the cost basis, proceeds, and resulting gain or loss. Accurate record keeping is essential for ensuring that these forms are filled out correctly. Self-employment tax for artists. Artists who earn royalties from NFT sales may also need to pay self-employment tax on their earnings. This is in addition to income tax and applies to creators who meet the income threshold for self-employment. Artists should consult a tax professional to determine their obligations and ensure compliance. Foreign tax considerations. NFT investors who reside outside of the United States or those with international NFT transactions may have additional tax obligations in their country of residence. Different countries have different rules for taxing digital assets, and it's important for investors to understand their specific obligations and report income accordingly. Hold NFTs for long-term gains. Holding NFTs for more than a year before selling can result in lower tax rates due to long-term capital gains treatment. This strategy can be particularly beneficial for high-value NFTs that have appreciated significantly. Offset gains with losses. NFT investors can offset their capital gains by selling other digital assets at a loss. This strategy, known as tax loss harvesting, can help reduce the overall tax liability. It's important to be mindful of wash-sale rules, which may disallow the deduction of a loss if the same or similar asset is repurchased within a short time frame. Consider tax-advantaged accounts. Some investors may be able to use tax-advantaged accounts, such as self-directed IRAs, to invest in NFTs. This allows for the deferral or avoidance of taxes on gains, depending on the type of account used. However, investing in NFTs through retirement accounts can be complex, and investors should seek professional guidance before proceeding. Consult a tax professional. The tax rules surrounding NFTs are complex and vary by jurisdiction. Consulting with a tax professional who is knowledgeable about cryptocurrency and digital assets is highly recommended. A tax professional can help investors navigate their obligations, minimize tax liability, and ensure compliance with all applicable regulations. As the NFT market continues to evolve, tax authorities around the world are working to update and clarify their regulations regarding digital assets. Investors should expect more guidance and potential changes to tax laws in the coming years as governments adapt to the growing popularity of NFTs. Staying informed about these changes will be crucial for investors looking to manage their tax obligations effectively and avoid potential penalties. The rise of decentralized finance, DeFi, and the integration of NFTs into gaming, virtual real estate, and other industries will also bring new challenges and opportunities for tax planning. Investors should remain proactive in understanding how these developments impact their tax liabilities and take steps to stay compliant as the landscape evolves. Crypto taxes can be complex, but understanding the basics of how NFTs are taxed is essential for investors looking to navigate the digital art market. From recognizing taxable events to differentiating between capital gains and ordinary income, NFT investors need to be diligent about their tax obligations. By keeping accurate records, consulting tax professionals, and utilizing strategies to minimize tax liabilities, investors can ensure they remain compliant while maximizing their returns. As tax regulations continue to evolve, staying informed will be key to successfully managing your NFT investments in the long term. Thanks for watching today's video production. Remember, all content on CryptoCurators.today is strictly for educational purposes and is not intended as financial advice. If you found our video enlightening, please smash that like and subscribe button if you haven't already, and share your views in the comments below. We appreciate all your feedback. Don't forget to join our community forum at CryptoCurators.today for additional engaging discussions. Until next time, keep exploring the world of crypto with us.